99% of economists' forecasts are wrong. Yet, as soon as economists drops a new forecast, headlines start screaming, house prices to plunge 20% or interest rates to drop next quarter. More often than not, they miss badly. Then the journalists start writing new articles about how the economists got it all wrong. It's actually enough that the chief economist at the Reserve Bank, Paul Conway, complained that journalists keep writing these kinds of gotcha articles. So in this video, I'm going to show you why 99% of property predictions are wrong and what you should pay attention to instead. Hey friends, welcome back to the channel. I'm Ed, an economist at Opus Partners. And if we haven't met yet, I've recorded over 2,000 episodes for the Property Academy podcast to teach you about property and finance in New Zealand. I also wrote a book about it. It's called Wealth Plan, and I've got a portfolio of 5 properties with my 6th on the way. And through all of this, I've seen how paying too much attention to the forecasts can lead people astray. Take 2021 as an example. So if you bought a property in November 2021, you would have thought that house prices, this dotted red line, were going to go up and then maybe come back a little bit. This was the Reserve Bank's forecast. What happened in reality was the dotted blue line where they went up, but then they crashed back down way more than anybody thought at the time you decided to buy that house. Take the interest rate forecast. This comes from ANZ, our largest bank. Again, look at that dotted red line. They thought that interest rates would only go up to 4%, whereas in reality, they headed up to 7%. So many investors I talked to who bought properties in 2021 at the height of the property market feel like they were really dumb, like they should have seen this big downturn coming. But forget what you know now and look back at the information you had at the time, if that's when you invested. All the people who are meant to know a thing or two about property prices and interest rates, they didn't see that big drop coming either. So if you're a normal person, it's okay that you didn't see those big drops coming too. I mean, here's another example. Back in 2013, Westbank's economists said that house prices were going to go down for the next 2 years. And they actually thought that house prices would go sideways for the next 4, maybe even 5 years. But instead they rocketed ahead, hitting a record high in 2017. So if you'd listened to that prediction, you might have sold your property too early and potentially left hundreds of thousands of dollars on the table. But how is it that professional economists whose entire job is to analyze data and predict what's coming next, how is it that we all get it so wrong? And more importantly, what should you as a property investor or home buyer pay attention to instead? Well, hold that thought just for a sec, because if you want to see more of these economics explained type videos, do me a quick favor and hit the like button. That's how I know what videos you want to see more of, and honestly, it just helps the YouTube algorithm too. Subscribing, that also helps. We're over halfway to our goal of growing this community to 50,000 subscribers. And if you are new to the channel, you might think that economists just pick their predictions out of thin air, like they all gather around in a circle and say, I reckon the 1-year rate's going to be 5.5% next year. What's your gut feel, Steve? No. Most economists build models. So they come up with a mathematical system for how they think the economy works. Then as they feed new data in, that model starts to spit out more new forecasts. And this can all look good on paper, but then real life gets in the way and all of a sudden a war breaks out in Ukraine or in the Middle East, and that disrupts supply chains. That means more inflation. Or a pandemic hits and we're all locked in our homes and the economy plummets. Or what about if the US starts threatening new tariffs and confidence takes a hit, so businesses stop investing? And boom, all of a sudden those old forecasts are pretty much useless because we've got new information to feed into that model. You know, the reality is that economists' forecasts are just future snapshots based on what we know right now. And maybe if the world could hit pause and nothing changed, then yes, many of those forecasts might turn out to be correct. But the world doesn't wait. It keeps shifting, and every economist will acknowledge that. And the truth is that 99% of property forecasts are wrong. The other 1%, the economists just got lucky. So do we ignore the economists, or how do you use what they give us as an investor or home buyer? Well, I wouldn't throw them out just yet, because looking at a couple of bank forecasts can give you a sense of where things might go based on today's thinking. So if I look at the latest house price forecast, ANZ thinks that house prices will be up 6% by the end of the year. BNZ, they say 6.8%. ASB, bit more conservative, 3.4%. Now, the good news is that that might make you feel comfortable, because it kind of summarizes where today's thinking is, even if you know that it won't work out that way. So you can't look at it as gospel and think, well, that's exactly what's going to happen, because these forecasts change frequently all the time. You know, even if you look at the Reserve Bank's OCR forecast, and remember, they control the OCR. Well, look at this dotted line in 2019. See how they thought that the OCR was going to go up a little bit, wherein in reality, it crashed right down. What about in 2021? Well, they thought the OCR was going to go up, but just, peak around 2.6%. That's the dark dotted line here. In reality, it spiked up to 5.5%. But coming back to Paul Conway's complaint, remember, he's the chief economist at the Reserve Bank. His real complaint is that people use economist forecasts for things that they were never really designed for. They're not there to be right, they're just outputs from a spreadsheet. They can help inform your decision, but they shouldn't make your investing decisions for you. Whether you buy a house, refinance your mortgage, fix for a long or short interest rate, it's ultimately up to you. You can't look back 2 years later and think, well, that economist lied to me. That's probably not what their forecasts were for. So what do you look at instead? Well, instead of relying on forecasts that change every month, I like to make it simple for myself as an investor and just look at the long term, but probably not in the way you're thinking. When I look at most property companies, they'll say, over the last 20 years, property prices in Mangere Bridge, or whichever suburb you're looking at, they went up in value by 8.3% per year, or whatever it happens to be. And when you look at that, you'll probably think, great, all I need to do is buy a property in Mangere Bridge, or whatever suburb, and it'll go up by 8.3% a year on average. Except it won't, because that long-term average only looks at two things. What was the price 20 years ago, and what's the price today? And then you just create an average over that time. Well, that's not what you should look at when you're thinking about how fast your wealth could grow, because you're not buying in the year 2000, you're buying in 2025 or 2026. So a better way is to say, okay, show me what would have happened if I bought a property in Auckland or Christchurch and held it for at least 10 years. Because then we're not just looking at one time period, we can look at 267 different periods. And what we see is that over the average decade in Auckland, property prices went up by 7% per year. Now, again, you might think, that's pretty good. When I go to an online calculator, I'm just going to use 7%. So if my property's worth 800K, let's see what happens if it goes up by 7% a year. But here's the trouble with averages. If the average is 7%, then half the time you'll do better than that, and half the time you'll do worse than that, because that is what an average is. And that means that if you go onto that calculator, you've basically got a 50% chance that your property performs that way. And that's if the property market performs just as it has done in the past. So how do we make this more robust? Well, the way I think about it is I don't just want a 50% chance that my property hits my forecast. I want a 2/3 chance or a 75% chance. And that's where you can say, okay, half the time properties in Lower Hutt went up by 6.8%. But 3/4 of the time they went up by at least 5%. Well, this line of thinking makes me feel more comfortable with investing. And I do get the irony here of an economist sitting here saying, hey, here's what I do, especially when the video is 99% of property predictions are wrong. But what I'm really trying to say is, rather than looking at the forecasts that come out of someone else's economic model, here's a way to create your own, if you're into that. And that all sounds a bit nerdy, but what it really means is that when you're estimating your numbers, when you're using online calculators, use predictions that are below average when you do run those numbers. That's whether you're using like a compound interest calculator to figure out how much your shares could make you, or whether you're thinking about investing in property and using software like Opus Plus to run your numbers. Now, if you're a normal person, you're interested in investing, but you're not super nerdy, this is your permission to ignore economists' forecasts. Don't make six-figure investment decisions based on someone else's headlines. And if you are super nerdy, then you can still look at the forecast. Just remember that they might inform your decisions, but they shouldn't make your decision for you. And when you're thinking about how to invest, some people will say, all you need to do, buy low, sell high. But trying to time the bottom of the market can sometimes actually cost you more. And if you want to hear about that, check out this video about why timing the market can make you less money and what to do instead.